Hello and welcome to BQ Prime. I'm Hiral Dadia. A very good morning to all the viewers. Joining us on the show today is Rohan Mehta, founder and portfolio manager at Turtle Wealth, to discuss the movers and shakers and the newsmakers of the day. Rohan, good morning and welcome to the show.
Good morning.
Rohan, let's start off with, a lot of stocks actually which are in the offing today. If you see, my first bet would be with regards to IPCA as well as Unichem. Now, in terms of the acquisition as well, what do you make of both these companies? Plus, you have an open offer that's coming in as well. What would you advise an investor to do with both these stocks?
So if you see individually, IPCA and Unichem, both are a decent company, but Unichem, if you see, still quoting at good losses. And for IPCA, there was no other better deal than, to club a certain company and go forward for it. See, the street has taken it very negatively because taking it Unichem as a business, it would maybe, we believe that it won't be a great merger for at least 2 to 3 years. And that's what street also has gone through the same. So we're still waiting for the clearance of certain regulations which are going to come with open offer and certain stock point like this. But as an investor, if I already invested, I would wait for the time and look forward for how the deal is panning out, because certain times the street doesn't understand the longer term effect over the period of time. And then maybe after the open offer and the things get settled, then I'll look forward for it. For a new investor, again, it would be hold a procedure, let us see how it pans out and then come into it, because see, this mergers and acquisitions and M&A are a bit tricky thing, which you cannot sum up in a day or two. So just wait for the time and then look forward for investment opportunity.
But however, Rohan, if you have to look at IPCA and Unichem separately right now, do you think it would warrant a good investment bet in terms of Unichem, taking into consideration that it's getting merged with a better company and prospects would increase? Do you think that could have an implication?
Yeah. So I think so. Unicam makes a much better deal just because it is going to be merged with IPCA. See, if you see onto the line, still Unicam make a good loss of nearly about 100 crores what TTM profit. It's a decent business, not a great business. Manufacturing of API, generics, very competitive. But yeah, Unicam makes a better deal than buying IPCA for sure.
Right. Moving on from one of the newbies, you have a Zomato that is in focus today. And this is because Zomato and Swiggy are introducing monetization with regards to their dining out segment. Now, Citi has clearly come out and said that, this is going to be a limited rollout for now. It could be positive with regards to the medium term as it opens doors to direct customer monetization. How would you view a Zomato, firstly, from a valuation perspective, two, with the monetization plan, and three, at current levels, what would you advise an investor to do?
See, we at our fund invest only into profit-making companies. If it won't be a rule, I would have invested into Zomato very on a very clear term, somewhere around 50-60 rupees. See, they have created a super niche into Indian complicated delivery markets, and food is one of the biggest spending what we do as a human being. From our total earnings, nearly about 15 to 20% has been spent on food. And today, my daughter, 6-year-old, knows that nothing. Yesterday, she told that, Daddy, we don't go for a waffle. We will order on Zomato or a Swiggy. And that has been cultivated in at least all the urban semi 1 tier, 2 tier, and 3 tier cities. And being oligopoly of Zomato and Swiggy to look forward for that business. And I don't see any other company now to take ahead this delivery business of the market dominance is superior. Second is that, see, whatever valuation shared what they wanted to have, I think so that's already now onto the place. Now the stock will consolidate. We have nearly about 350 crore of loss on the books, that I think so it would be positive by 2024-25. And once the things goes positive, I think so it's one of the best business to look forward for. Also doesn't see onto the monetization front, there are so many unlimited opportunities which comes to the picture. Recently I was in Mumbai and my friend told me that they have come up with some luxury ordering segment. Like from Mumbai, if I want to order a Hyderabadi biryani, I can order.
Yeah.
They will put it into flight and they will get. Now come on, that's people crave for food, and food is something which now they have kept it so comfortably onto the plates at your home. Nothing amazing than that. Maybe 1-2 years more down the line, the growth may come. But overall, I think so the valuation shredding down the line, I don't think so now there is downside of more 10 to 20% also on the.
Hmm.
So it's a clear buy, but a vision of at least 3 to 5 years down the line, and it is one of the biggest wealth creator that I'm looking forward for.
Right. So that's with Zomato. Moving on, Crompton Greaves, 11 to 12% cut coming in there. And this is on the back of where Shantanu Khosla has been elevated as the executive vice chairman. And you have ex-Temasek India deputy head, that's Promeet Ghosh, who has been appointed as MD and CEO. Now, clearly, the firm CEO and executive director, which is Matthew Job, has resigned and he will be stepping down with effect from, I think, the 30th of April. What do you make of this announcement and why such a cut coming in terms of the stock price?
See, basically, we're not very into Crompton, so not have a very understanding of the management inside.
Hmm,
But if you see also in what I was checking onto the company was this company had corrected from a very long period of time. So it is not that this correction has just started. So if you
hmm,
see from 2021, somewhere around from 485 to 294, somewhere around 300 of area. And then we again see a cut of 15-17%. So this was being carried ahead from last 1.5 year. Maybe it was a part of non-performance to management issues. So what I understand from this type of setup is that street has not taken the management to be whatever who has come into on a very positive note, and once it is not there, it's a very scary time to invest into that particular stocks. And
hmm,
specifically if you see Crompton, when it comes, it's not very cheaply priced also. At the higher point it was 40-50 times onto consumer electric business, which is as segmentally very
hmm.
competitive and superiorly, like companies like Whirlpool and companies like Havels are also not performed, not exactly the same peers, but somewhere around the same sectors we are talking forward for. So I would believe that it's not a healthy time, and would not recommend to exit or enter, but sometimes exiting and then seeing forward for what it is happening would be more advisable.
Right. Moving on, another stock from the banking space is the Indecent Bank that is in focus. And this is again on the back of Q4 numbers. Overall, good set of numbers in terms of profitability. In fact, when you see consensus brokerages as well, they are expecting a tad above 40% rise in terms of the bottom line from here on. They've recommended a dividend of 14 rupees per share as well, provided they get shareholders' approval. What would your view be on an Indecent Bank versus the other banking majors?
Yeah, see, Indocent looks on number wise, it looks fab, right? I don't know
Hmm,
why the value has been not created in the bank, and maybe the reason is what I'll point out after my numbers. See, the company has posted the highest quarterly numbers of their lifetime, more than 2,000 crores of PAT, right? And that's fantastic. With a TTM profit of somewhere around 7,500 crores, with top line is good, and all things are good. But see, whenever if you've seen in last 3-4 years, whenever there has been a panic in the market, IndusInd Bank has hit the highest. There has been some corporate governance which market is not looking forward for on a very positive zone.
hmm,
See, the same thing has happened lately. If you see post a pre the Chanda Kochar side of the management in ICICI
hmm,
Bank also, numbers were posted very well, the things were very well, but street never took it seriously. So that's where the finance companies look so serious, is where the corporate governance comes too much into place, where people are confident enough that okay, fine, this is a bank, whatever happens, it is going to get the worst in the worst time and is going to best in the best time, which doesn't happen with Indocent Bank. So the re-rating still happens, the price doesn't get an impact. If you see number wise, I think so this should be the most valued bank in a private
hmm.
banking space. But if you see the corporate governance side, I think so there has been a lot of questions into the bank. That's the reason re-rating or a clear value appreciation doesn't happen into Indocent Bank. So on that segment, still, your second question comes to it, that in the peer side, we feel still HDFC Bank from last 2 years have not performed, and because of the merger of HDFC and HDFC Bank, HDFC Banks looks too much on a value side, and on the growth side, we are very bullish into Axis Bank, because Axis Bank has seen 5 years of underperformance, superior change in the management, extraordinary aggressivism as a business front. So Axis Bank and HDFC looks more better for us.
Right. Moving on, the railway stocks are in focus today. You have RITES as well as RVNL. Both these counters, volumes have been pretty strong. RVNL, in fact, has hit a new 52-week high, and the volumes are strong. Clearly, it's the order book that's coming in, and the the contracts and orders that are coming in from the Ministry of Railways is something which is auguring well. Obviously, the execution timeline is going to be, at least from here on, 2 years from now. What would you advise an investor to do at current levels with both these counters?
See, I think so. Let us not see only this counters. I think so. Major onto the PSU side and specifically on the infrastructure PSUs.
Hmm.
So, see, every 10 years, every decade, whenever there is a bull market, there is certain sectors which does much more better than the average sectors. So, maybe in last decade, it was quality and chemicals. This time, we have very strong belief that it is a lot of possibility that, PSU can be one of the part of it. See, let us see on the valuation side. These companies are available at 15 times, 10 times, 2 times, 5 times. This is throwaway valuation. When I meet startup companies and then they
Hmm.
put it on 500 times on their sales, I sometimes laugh on myself that why I'm going to listen to this pitch where I have a company which does a consistent level of profit and it is available at 15 times or 10 times of the profit with superior management and a great sales with the order book and a superior
Hmm.
dividend making also. So on that scale, I think so companies like IRCON, RBNL, these are all companies nobody's interested to look forward for, but these companies would be surely giving us surprise and jitters in next 1 to 2 years. So it's a clear buy. Yeah, of course we need to see how the growth happens,
Hmm.
but I feel that companies like RBNL and this type of companies are no brainer to buy. Just go forward for that portfolio, and if they are showing this strength in bad markets, like let us say it's not bad market, it's like a pig market, nothing is happening. I'm sure when the bull market happens, it is the time these companies are going to get more fuel for growth.
Right. One last talk that I want to discuss with you is a UPL. Now, this is an interesting one because you have a global agrochem major, which is Adama. They have actually posted a weak set of numbers, and that is what has actually dented the sentiment of UPL. Now, overall, both these companies operate in the same geographies and segments, and a muted commentary coming in from a global player. How do you think is UPL placed? Because the 1 year as well, 10 to 11% kind of cuts that we've seen on the counter. From a valuation perspective, is it best to avoid? And if you're already invested, what would you advise to do?
So UPL is a very, very curious business. From 4 5 years, I'm looking forward for whenever I
Mm,
meet a company, whenever I meet the management, I get so excited. This company is doing so fantastic, and we should get it into our portfolio. And something which we are not comfortable with, either it could be debt, either it could be the profitability. If you see on the business structure, if you
mm,
read the script of the business, you feel, my God, what a business you are looking forward for. And then when you see the debt structure or some capital acquisition or the foreign company you are talking, there where we are not comfortable. One of the metrics we consistently see also is how the stock is outperforming Nifty
mm,
500, which is generally the benchmark index. And if you see, the whole chemical as a segment has done exceptionally well in last 10 years or maybe 7 to 8 years, where UPL didn't do anything. So on that segment, it has always underperformed Nifty 500. It has always underperformed the peers of chemicals into the picture. So that's where we were not very comfortable to buy it. So I feel it's an avoid. It's a great company. It's a good company, but
mm.
somewhere the re-rating of the prices are not happening, and that's where we want to see how the re-rating happens, and then we want to go into it.
Right. So that's with regards to where UPL goes, a re-rating, a mandate that Rohan is mentioning as well. Thank you, Rohan, so much for joining us on the show and discussing these movers and shakers and what investors should do with them. Thank you. Stay safe and speak to you soon again.
Thank you. Have a good day.
You too.